Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, December 19th at 11 a.m. in New York. So let's get after it. While many commentators blame last week's sell-off in stocks on the Fed, we think it was more about the equity market looking ahead to the oncoming earnings recession that we think is getting worse. The evidence for this conclusion is last week's drop in valuations, which was driven exclusively by a rising equity risk premium as 10-year yields remain flat. In fact, since mid-November, the equity risk premium has risen 50 basis points to 2.5%. While still very low relative to where we think it will eventually settle out next year, it's a good step in the right direction that tells us the equity market is at least contemplating the earnings risk. Until now, all of the bear market valuation compression has been about inflation, the Fed's reaction to it, and the rise in interest rates. While we called for the end of the tactical rally 2 weeks ago, last week's price action provided the technical reversal to confirm it. Specifically, the softer-than-expected inflation report on Tuesday drove the equity markets up sharply in the morning, only to fail at the key resistance levels we highlighted 2 weeks ago. More importantly, the price action left a negative technical pattern that looks like the mirror image to the pattern back in October when the September inflation report came in hotter than expected. We made our technical rally call on the back of that positive technical action in October, and last week provides the perfect bookend to our trade. Seasonally, the setup is now bearish too. At the end of every calendar quarter, many asset managers play a game of chasing markets higher or lower to protect or enhance their relative year-to-date performance. Most years, the equity markets tend to drift higher into year-end. As liquidity dries up, asset managers are able to push prices higher of the stocks they own. However, in down years like 2022, the ability and/or willingness to do that is lower, which reduces the odds of a year-end rally lasting all the way until December 31st. This is the other reason we pulled the plug on our tactical rally call. With last week's technical reversal so clear, we think the setup is now more bearish than bullish. Meanwhile, we are feeling more confident about our 2023 forecast for S&P 500 earnings per share of $195. This remains well below both the bottoms-up consensus of $231 and the top-down forecast of $215. In fact, the leading macro survey data has continued to weaken. I bring this up because we often hear from clients that everyone knows earnings are too high next year, and therefore the market has priced it. However, we recall hearing similar things in August of 2008, the last time the spread between our earnings model and the street consensus was this wide. The good news is that we don't expect a balance sheet recession next year or systemic financial risk. Nevertheless, the earnings recession by itself could be similar to what transpired in 2008 and 9. The main message of today's podcast is don't assume the market prices this negative of an earnings outcome until it happens. Secondarily, if our earnings forecast proves to be correct, the price declines for equities will be much worse than what most investors are expecting. Based on our conversations, the consensus view on the buy side is now that we won't make new lows on the S&P 500 next year, but will instead defend the October levels, or the 200-week moving average, approximately 3,500 to 3,600 on the S&P 500. We remain decidedly in the 3,000 to 3,300 camp, with a bias toward the low end given our view on earnings. With the year-end Santa Claus rally now fading, there is reason to believe the decline from last week is the beginning of the move lower into the first quarter for stocks that we've been expecting, and when a more sustainable low is likely to be made. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.